Nvidia stock is down 12% from its all-time high. You can see that in this chart here, and investors are really wondering what's going on. There's a lot of comments about, is Michael Burry responsible for this? He came out with a short position against Nvidia, but we did get a really good earnings report. So a lot of comments are, hey, the company's really doing great. Jensen Huang says there's a ton of demand. Look, there's more to the story here, and I want to go through exactly why the stock is down. And it doesn't come down to the recent earnings report. It doesn't come down to Michael Burry's position. It comes down to Nvidia's business model, who's buying their chips and their ability to buy those chips. This line from their recent 10Q is really what should be shocking to investors. 65% of their accounts receivable, that's going to be a proxy for their revenue, with 65% comes from just 4 customers. Those 4 customers are likely Microsoft, Alphabet, Amazon, and Meta platforms. So what those companies are doing, their interest in buying chips in the future is going to be really important to Nvidia. So I'm going to dig through some of the implications today and what investors are at least thinking about. It doesn't mean that the stock is going to continue to go down. Doesn't mean it's necessarily going to go back to all-time highs in the next few weeks. But understanding what's going on under the hood and the things you should be watching as an investor, I think is really important. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube. And if you want more from me, I got my newsletter. There is a link on the screen and a link in the show notes. And before we get too far, I do want to highlight the biggest sale of the year for Fiscal AI, 30% off on all their plans. If you go to fiscal.ai/ASYM, this is a tool I'm going to be using throughout this video, but this is the best research tool in all of investing. If you want to make phenomenal looking charts, if you want to have transcripts, investor presentation, all of it in one place, and their KPIs are just a cut above the rest. That's something you're going to see from me a lot here today and throughout Asymmetric Investing. So if you're interested in getting Fiscal AI for yourself, go to fiscal.ai/ASYM. Like I said, 30% off, and that only goes through December 1st. So this is a limited time offer here. So like I said, 4 customers accounted for 65% of their accounts receivable balance as of October 26, 2025. That is just a snapshot, but worth noting that is a higher concentration than they had at the beginning of the year in January 26th, 2025. So when you look at who these customers are, let's go through the first 4: Microsoft, Alphabet, Meta Platforms, and Amazon. Microsoft, no real change there with their relationship with Nvidia, although CEO Satya Nadella did say, hey, we don't want to necessarily over-index on one of their generations of GPUs, so we're going to maybe space out our purchases just a little bit. The other thing for them is they actually passed on being the sole cloud provider for OpenAI. Some of their stuff is still going to be on Microsoft Azure, but they're not going to be the only place. They have been making deals with all kinds of other companies, including Oracle. I'll talk about Oracle in just a second, but even some of the other neo clouds as well. So Microsoft had a huge bet on OpenAI and in turn on Nvidia GPUs, and they've kind of backed off from that. So not necessarily a red flag, but something worth noting. The next one to look at is Alphabet, one of the biggest cloud companies. Their cloud is growing like crazy. Shares are up to new all-time highs recently and have been surging on the market. Why is that? Because Gemini and their TPUs are absolutely on fire. Gemini 3 came out last week, a really good model. The Gemini application is gaining momentum. We're seeing that search is starting to implement artificial intelligence in really interesting and really useful ways. Is that going to stop the growth for OpenAI? I'm going to get to why OpenAI is something that I keep coming back to in just a second. But that's really the important piece here is Alphabet is not reliant on Nvidia chips. They are more reliant. They are building their models with TPUs, their tensor processor units. So that's something that we need to consider. If they start taking share from OpenAI, they start gaining momentum, that's going to eventually flow down to Nvidia. Then you get to Meta Platforms and potential deals with Alphabet to buy TPUs. If they end up moving from GPUs from Nvidia to TPUs from Alphabet, that's going to pull potential revenue growth from Nvidia and actually give it to Alphabet, which is arguably their biggest competitor in the ASICs market. Amazon, a little bit smaller player than the others in the GPU market, they have not had the same momentum in artificial intelligence and building out AWS and the AI capabilities there. So they're going to be a little bit smaller player. But the companies that you want to see growing if you're Nvidia and being more and more dependent on you are actually trying to become less dependent on you. And that's really the big trend here. Then we get to OpenAI. OpenAI is really the linchpin to Nvidia's growth. If OpenAI doesn't exist tomorrow and the $1 trillion plus in deals that they've made with companies like CoreWeave and Oracle all over the tech space, if all of those deals go away, Nvidia's backlog just absolutely dries up. And so that's really what we need to think about with Nvidia is they are much, much more reliant on the growth at OpenAI than any other company. What's the problem with that? Well, OpenAI plans to lose money at least through 2028. These numbers get really astounding really, really quickly. Company expects, this is according to the Wall Street Journal, losses to be up to $74 billion in 2028 alone. This year, they're projecting to be on about a $20 billion run rate by the end of this year. But at least based on this reporting, they have about $9 billion in losses this year. So the question is going to be, how long is OpenAI going to continue funding the next generation models? Their business model is not yet profitable. They're going to have to keep raising money to be able to fund the acquisition of data centers and all of the compute that they're buying from all of these cloud players who are eventually then buying chips from Nvidia. If OpenAI isn't able to get that funding, that's going to be a huge problem for them. And where does OpenAI's funding come from? Well, some of it used to come from Microsoft. Microsoft has backed away from that. Companies like Oracle have stepped in. But what's happened to Oracle? Let's go to the year-to-date chart and look at the drawdown. 40% drawdown in shares of Oracle. Remember they had that bounce when they announced that $300 billion deal with OpenAI. Their stock is now lower than it was when they announced that deal. So they're going to have to spend billions of dollars to build out the infrastructure to serve OpenAI. To do that, they have to take out debt. They had $90 billion worth of debt last quarter. When they reported earnings, they've actually taken out about another $20 billion of debt since then. So they have over $100 billion worth of debt. That cost of debt is actually continuing to increase as well. September, they issued debt at about a 4.5% interest rate. That interest rate on the debt as it's traded today is now up to about 6.5%. So if they're going to issue more and more debt to build out these data centers, that is going to become more and more costly. Now you have a question of, is OpenAI going to be able to fund their obligations? And also, is a company like Oracle going to be able to fund what they're trying to build and buy the GPUs? Because as we stand today, the investment that both companies are making is not sustainable. You might say, well, there's other buyers out there for GPUs. Well, one of those big buyers is going to be CoreWeave. CoreWeave, also about $14 billion worth of debt, not enough cash to really fund their operations. They're also not profitable. And keep in mind, their stock is dropping like a rock as well. Let's look at their debt drawdown, 60% over the past few months. Nebius is going to be another name, similar story. Drawdown is 32%. Again, not profitable. Need to fund some of these build outs with debt. So the real question for Nvidia is, who's going to be buying their chips in the future? I know that everybody says that they have plenty of demand. That's something that Jensen Huang is going to say no matter what operations look like. They're just not going to put a negative spin on things on an earnings call. You can go back to when things were really bad over the past decade. That's just not the way he talks about the business. But what investors are starting to think about more and more is, are the customers that are buying Nvidia chips going to continue to buy them at a higher and higher rate? Remember that investors are still expecting growth and they're expecting really strong margins. If we go back to Nvidia stock, a lot of people argue that this is a cheap stock, and you can look at a price earnings multiple on a forward basis of 26 and say, you know what, that is really cheap. But if you start looking at what their margins are today and their margin profile versus where it's been in the past, look at the operating margin line. Just a decade ago, they were doing about 15% operating margin. Now they're doing about a 60% operating margin. So operating margin is up about 4x. That's showing you the pricing power in the market. So the question of, are customers going to be buying chips? Well, that's a volume question. The other question is, what are they going to be paying for those chips? Are they going to be able to squeeze Nvidia a little bit and be like, you know what? Happy for you to make a little bit of money, but you making a 60% operating margin, that's just too high. We need a little bit lower price. That could squeeze those operating margins, squeeze that profitability. And remember, all of this is coming down to a lot of debt financing. Those big companies with tons of cash flow, Microsoft, Alphabet, Meta, they're trying to move away from being reliant on OpenAI and being reliant on Nvidia chips. So if you're now reliant on these neoclouds, on these companies like Oracle who are taking out hundreds of billions of dollars worth of debt to build out data centers, now suddenly the business model becomes much more risky, becomes much more fragile if there is some sort of downturn, if the market confidence that has been pumping the value and the money that's going into OpenAI, if that suddenly disappears, that's going to flow its way then to Nvidia. So all of these things are playing on investors' minds right now. The fact that Alphabet came out with a really good model and Gemini seems to be kind of pulling back attention, that could just be the catalyst for some of these other things falling apart. So that's why the stock is down. Like I said, doesn't necessarily mean the stock is going to continue to fall, but it is something that investors are going to want to monitor. Because if revenue growth slows at Nvidia, if these margins start to come down, now you start to get multiple compression, there is significant downside potential in the stock. And remember, Nvidia stock has fallen 70, 80% before. It's possible that it could happen again. And it all starts with that customer concentration. 65% of accounts receivables being with 4 customers is incredibly high concentration for the most valuable company in the world. Like it or not, Nvidia does not really control its own destiny. That's a risk that investors are starting to think more about today. Let me know what you think about Nvidia's position today. Leave your comments in the comment section below. Like I said, check out fiscal.ai/ASYM if you want that research tool. Definitely highly recommend it. It's something that I pay for myself. And check out my newsletter, link on the screen and a link in the show notes. Thanks for watching, everybody. We'll see you here next time.